Hi, my name is Christopher Terry, CEO of iMarkets Live, and I want to talk about wealth creation and really how it relates to trading and also using the power of leverage and knowing when to use it. When we look at wealth creation and we here in the network marketing arena, we're here in the trading arena, the power of compounding. And it's always that one example. If you took a penny and you doubled it over a period of 30 days, or you'd have 5 million, or 31 days, you have $10 million. So if you took a penny today and you doubled it each day, each day, each day, right? It doesn't look like much is happening, but you're accumulating. And the more you accumulate, it just starts to increase. And the power of compounding starts to kick in. Now, this is dramatic, and it's not obviously not uh, theoretically real, but we do understand that the banks use the power of seven, which what they do is they take 7% a year and they compound it. So what we'll do, let me just show you. So the banks, when they do the illustrations, they basically look at if you were to compound 7% over so many years. So 7% and then 7% on top of that, and so on and so forth. And they continue to grow, adding 7% each time. And that's a fair number over a period of time. The problem with banks is they give out 1%, but they talk about compounding 7. As you see here, just in this little mathematical model, that the power of compounding once again, where you're starting at 10,000 and over 31 periods later, it could be a month, 31 months, 31 weeks, 31 years, whatever the factor is, you can see how it just starts to compound and really gain momentum as it goes up. I'm using the number 31. Let's just say over a 2-year period right here. Okay, so let's just get rid of this. Clear those contents. So if we look at trading, and I know we're all traders and we look to make high amounts, and let's just use the factor of 10% in a month, which trading on leverage, trading forex and futures, obviously there's a lot more money to be made. But let's just say hypothetically, you started out at 10,000 and each month you work to earn just 10% on your account. Okay, you can see how the power of compounding starts to kick in, and in just 2 years you have yourself nearly $100,000, $90,000, just by growing it a little bit at a time. This could be weeks, this could be months, this could be years. It's all dependent on the person and how much they leverage. I want to speak a little bit about the power of leverage, and we see the power of compounding. All right, and in the world of trading, it's fun, it's great to have that kind of power. So the U.S. brokers typically give 50 to 1, 50 to 1 in the forex market, and that means basically for your $2,000, you could leverage 50,000. Oh, I'm sorry, 100,000. Oops, right there. All right. Now there are brokers that allow 100 to 1, and you have 200,000, right? And then you got brokers that give 500 to 1, which really is not the best to do. You got 1 million right here. And then you got some of these brokers that allow you to do 1,000 to 1. And that gives you $2 million leverage on $2,000. So utilizing the leverage of the 50 to 1, we could see using $100,000. So let's just say you have a $5,000 account or a $10,000 account. So let's just say you have a $10,000 account. Okay? Technically, you really have 50 to 1, right? So technically you have 5 times, you have 500,000 of money you can use. Okay? So on a $10,000 account, you could technically have 500,000 if you leveraged it correctly, 50 to 1. Essentially, you're doing 2,000, which is 100 times 5, it's 500,000. But on a $10,000 account, let's just say you want to grow it at a rate of 10% in the month. Okay? 10% in the month. It could be less, it could be more. So during the course of the month, you want to earn, you want to use one standard, which is $10 per pip, and you're seeking to get 100 pips in the month. That's all you're looking for. So a couple of trades, you put yourself at 100 pips, and you have 10% in the month. Now, whether you get 40 pips, whether you get 200 pips, that's irrelevant. I'm just giving an example of what you can look at and in terms of targeting for your growth, and also do something on a conservative level that if you do lose a little bit, you still have plenty, still have enough money to trade. Of the $10,000, if you're doing one standard, all right, you're using, and just say you're doing the USD pair, you're using $2,000 of the 8,000. You're not of the 10,000. You're not using the whole 10,000. You're using a portion of it. Okay, and this is where the leverage comes in. All right, so I see traders, they'll have $1,000. Okay, $1,000 account with 1,000 times margin. They have $1 million, and they're trading 2 standard lots. And yes, they make, it's $20 a pip. They make 50 pips. They made $1,000. Oops, they made $1,000, and they think, wow, I did 100% on my money, but not realizing that if they lose those pips, all right, they're wiped out. All right, you wiped out your account. So the main thing with trading is you want to really be careful about losing or wiping out your account in any one trade. Normal is you start here at say 10,000, you go up a little bit, you come down, you go up over time, you come down, you go up over time, you come down. All right, so you want to continuously look at how things grow. I'll show you a track record in a little bit that we used for our PowerPoint video, and it goes through our wins and losses for the past 12 months, and it'll make sense. But what I'm seeing is, I chat with people all the time, and I'll see them go from 1,000 or 10,000 to a straight up like this. Okay? They go straight up. It's unsustainable. And then it's down, and they took their demo account, they reset it at 5,000, they started over again, and they go up, and they go down, they reset it again. And I would like to see long, sustainable growth over a period of time, and you end up compounding and create wealth. All right, because you will have times where you have days, weeks, months where it's just the market's just not going to do the right thing for you. All right, you're just not going to be on your game. It's human nature. Okay, and to lever up every single time, you're better off going to a casino. All right, or maybe you're treating it as a casino. You don't want to do that. You want to lever it up over a period of time. So let me show you something. All right, this is the one we use for our PowerPoint. This is from our live trade signal service, but it's just an example. All right, I don't mean to show you nothing, but it's just an example, and I want to point out something. Okay, we started in at one point with 10 grand over a period of time, but you see how you're going to have your winning streaks. You're also going to have times where you go sideways, even down. And then you have those times where it just continues to grow. It's over a period of time. All right. I'm human and I have my losses, right? But I can have a string of losses and still maintain a safe growth over a period of time. This is a real track record because I know I see some of the stuff on the internet where, 0 to 6,000, and you just have to question yourself. But over a period of time, there's nothing wrong with making a bunch of pips. Okay, let me just fix this here. Let me just fix this. There we go. All right, down here, over a period of time, pips. So, although some people may look at it and say, well, it's only so much. Well, the difference is we're in the game a year later. All right, and you could do multiple times that. The factors, that's not the point. The point is you do not want to leverage. We're using 1 to 3% risk on trades. So you're growing it. If you're taking your losses, you're keeping them small, and you're growing it over a period of time, you're going to have long-term sustainable success. That's a normal track record. Wins and losses over a period of time, not just getting in and losing. So I want to talk about size. I want to talk about trade size. I want to get into that and show you some thoughts. Okay, one of the things that you want to look at when you are trading is that, let's just say you have a account, $10,000. It could be 1,000. It doesn't matter. All right, and you have your 50 to 1 leverage, so you have 500,000. All right, and I know some of you are probably thinking, oh, I can go to this company and get all this leverage. Let me show you something. I'll use this company for an example, and this is a great company, Traders Way. They're a great, great company. A lot of traders use them. They have great leverage, and leverage should be respected. Okay, leverage should be respected. I'm going to get into an example of how to maximize yourself with leverage, but you want to respect it. So when traders look at this, newer traders, they look and they think, wow, I can get 1 to 1,000 ratio. That means my $1,000 times 1,000 is $1 million. So for $1,000, I could leverage $1 million. And that's true. Okay, you physically have it here. They give you the leverage. You can physically do that. All right. Minimum deposit. There's no limits. They got great spreads. Okay. However, the one thing nobody looks at is, let's see, risks. See that right here? New to the market, risks. And you scroll down and they talk about your risks. They talk about the power and leverage. They talk about if you had a 100 to 1 leverage, that you can leverage the EUR USD, which is normally 3,000 on a 50 to 1, right? But with the 100 to 1 leverage, you can do it for 1,400, and literally on 1,000 times, you can do it for 140. But in little writing at the bottom, observe capital management rules. It says it right here. So let's think about this. These rules aim to restrict losses on any given position. Most importantly, your losses should be no more than 2% of your deposit. So if you have $1,000, $1,000, your risk should be no more than 20 bucks. Okay, so you ask yourself, wait a second. They're telling me I have 1,000 times leverage or 1 million, but I can't risk no more than 20 bucks. That's silly. You have to ask yourself, right? That's only like 2 ticks on a standard. I can do crazy standards. Well, there's reasons for this. All right. And I'm going to go into this. I'm going to explain it a little bit more on how to use leverage, on how to maximize the power of leverage, but not abuse it. Abusing it means you start your account, you got $1,000, and immediately you're buying 2 standard lots. You're $20 a pip. You lose 20 pips, you're down 400 bucks, and now you're out of the game. You work so hard to get your money, and in a few pips, you're out of the game. But if you have some successes right away, you feel like a genius. I took $1,000. It's worth 5,000 now, or 3,000. Yeah, but what if you start losing? That's the thing. So, Trader's Way, who gives $1,000 leverage, says don't use more than 2% of your deposit. Don't risk more than 20 bucks per thousand. So when I tell somebody we risk 1 to 3%, they laugh. I had somebody laugh at me. Oh, that's silly. Okay, that's silly. I'm in the markets for 20 years. All right. I've created ridiculous amounts of money, fortunes. And here's a guy who doesn't know anything is telling me that's silly. Yes. Let's go back to that spreadsheet. All right. Let's go back to the spreadsheet. All right. A little bit of growth, a little bit each time can lead to massive amounts of wealth. All right. Realize that. And you also want to restrict, even though the broker's telling you you have 1,000. So what they're saying is, we're going to give you a rope, and it's up to you not to hang yourself. My father used to say that when I was young. Son, I'll give you all the rope you want, but you get sloppy, you're going to hang yourself. And of course, I was a kid, and I didn't know what that meant until I hung myself and I got in trouble, basically. And I had, he grounded me and all this stuff. I'm 49 today. I was talking when I was a kid. I want to show you really what you can do with leverage. So let's just say you have a $1,000 account. A $1,000 account. Now, because you have $1 million doesn't mean you have to eat up the 1 million. So you're using 1 to 3% risk. Okay? 1 to 3% risk. That means when you take a trade, let's just say the trade is 30 pips. 30 pips risk. We have another one for 50 pips risks. And we have another one for 100 pips risk. And let's just say we're going to risk 1%. Okay? For argument's sake, 1%. So, even though you have 30 pips risk, okay, my marker here, you're going to risk $10. All right, $10. $10. That's your risk. All right, and those of you that are looking at this going, but I got 1,000 cash, $10 is nothing. You're not getting the idea of how to create wealth. You're getting the casino mentality, and we know what happens at a casino, right? Everybody who comes to a casino leaves broke. Your goal is to create wealth, not leave broke, not put all your money on the table at one time, because you will lose. You will have losing streaks, and professional traders look at losses first before gains. So let's start with the 100 pip risk. 100 pip risk at $10 means you're going to use 0.01. You're going to use 1 micro lot. Okay? 1. Here, you're going to use 2 micro lots. And here, you're going to use 3. 3 micro lots. All right? So, 100 100 pips. So you got standard. Let me just get this so you understand it. There's one standard, one mini, one micro. Okay, sorry for my. So when you look at MetaTrader 4, that's a standard. This is a mini. This is a micro. Okay. So a standard lot, if you risked 30, let's just say 100 pips, 100 pip risk. Oops, 100 pip risk is $1,000. Can't do that. If you risked 100 pips on a mini, this is $100. That's 10% of your account. Okay, this is 100% risk. And one micro, 100 pip risk is $10. So essentially, if you say I want to risk the maximum 3%, okay, you just triple the numbers. This would be 3, this would be 6, and this would be 9. Okay? And this would be 30, 30, 30. And you would not have an account if you risked 3%. You did exactly this, right? So, what we look at as professional traders is you want to maintain that 1 to 3% risk, and Trader's Way is essentially saying 2%, and I agree with that fully. But we still have that 1,000 times leverage that they talk about, right? It's still sitting there. Well, how do you use that? Well, let's talk about it. Let's talk about how to use the leverage. Let's look at some charts for a minute also. Let's look at some charts. All right. So, let's just say you got into the market. Oops. Let's just say you got into the market right here. Actually right here. Okay, right here. You got on for a short sale. Okay. You risked 1% on your account or 2%, it doesn't matter. And the market went down in your favor. So now the market is down here. All you're doing is now you're bringing your stop loss here to break even. So trade 1, you did a sell short, and the market went in your favor, right? So now you had a 2% risk, hypothetically. And now the market went down here, and now you move your stops to a little bit under break even. So if this was your entry, you now bring your stop. So essentially you have zero risk, right? So now you went from 2% down to zero risk. So essentially what you did was you started off with small risk. Market worked in your favor. Okay, let's just say it worked in your favor. And forget about that it went back up. The fact is you broke your stops to break even. You now have zero risk on the table. Okay? Zero risk on the table, and you're short the market. Well, that's fine. So you're saying to me, Christopher, okay? Chris is saying to you, wait a second. You shorted the market here. Let me see if I can get a better, oops, I did something wrong. There we go. Shapes. So, is it me or I can't seem to make this thing work? Okay, shapes, eclipse. Okay, we're gonna continue to work with this, work with what they got. So we shorted the market right here, and now the market is down here. This was your entry, and now you bring your stops to right below break even. So what you done was you brought yourself down to a goose egg, no risk. Okay. Now remember, you still have a position on, right? You still have a position on, and you've eaten up a percentage of your margin. All right. So standardly, basically, you've eaten up a percentage of your margin, which is decreasing your free margin. So if you started out with 1,000 and you used $20 or 100 bucks, $50 out of this, whatever, you now have $950, what they call free margin, which means that you're in a trade, you have zero risk, and you still have all this margin to use. All of that. That means that you can look at another pair. Okay, let's just use this. Let's take a look at this. So you say to yourself, wow, I could trade. This is my harmonic scanner from the company, actually. Okay, this is a harmonic scanner from the company. So we look at it and we say, okay, 2% risk is 100 bucks. All right, this is on a $5,000 account. Here's your risk. Here's your entry. And let's just say you actually took this trade. Okay, you're right here in the trade, and your stop would be break even right now. Okay, so essentially you're eating up a little bit of margin, right? You're using 0.67 lots on 5,000, but right now you have no more risk, so you can go to the next trade. So if you look at your portfolio, you can have a list of trades. You could have the EU, EUR, you can have the JY, you can have the GA, GBP, AUSD. But as you start to profit and you bring in the risk down to zero, all right, as you're bringing the risk down to zero, meaning if you would have shorted it here, the market's here, you've got zero risk now because you break even. You are eating up your free margin. You're eating this up right here. And this is decreasing because now if you did a trade, for instance, a 0.67 on this, you would be eating up all that free margin. So let's take a look. Let's take a look at the videotape here. See if I can open up the terminal and show you. Let me just do 6.7. 6.7. All right, so let's just say you did. Okay, I may have screwed something up here, so hold on a second, please. Okay, I see what I did. I turned it off for this account, so all right, no big deal. So anyway, the point is, you have your trade you entered here. It's come down this far, and you have a break-even stop. Essentially, you have zero risk on the trade, but you're eating up your free margin. Some pairs have higher risk than others. The EUR CHF, since it's the CHF, there's a higher value attached to it in terms of margin and risk. All right, I'm using this as a demo account that I'm using here just to show some example. All right, let me just fix this. All right, so that's how, when we look at trade margin, that's how professional traders look at it. Trade one, okay, you do the EU. You do 2% risk. And when the market's in your favor, you have a break-even stop. You have zero risk. 2. EJ, okay, 2% risk. All right, and then when it comes in your favor, you have 0. You can either take the profits off the table or you can continue to add positions. So when you're looking at free margin, because you have $1,000 in an account, you have 1 million free margin. In the US, okay, most of the brokers, you have 1,000, you have 50,000. All right, you have 50,000 in free margin. All right, so that's where the limitations come. If you were to do multiple positions, for instance, this one may cost you so much margin, this costs so much margin, and every time you do a trade, it lowers your free margin down. All right, uh, it lowers your free margin down to lowers it down. So you're able to leverage. You have cash, and then you have your leverage money. Every time you put a position on, it takes away from your cash amount, your margin money. Okay, so you want to keep that in mind when you're trading and you're using leverage. You don't want to come in and put a heavy position on your cash. So what Trader's Way was saying was that, yeah, you have 1,001, don't risk more than 2%, but that 1,000 can be utilized over multiple positions as long as you keep in the overall risk small. And how you're doing that is you get a position that's in your favor, you bring your stops to break even, you add, and you can build up a portfolio. Maybe you like to trade 4 or 5 positions. All right. So rule of thumb: 1 to 3% risk per trade, and two is no more than 6% on a combination of trades. All right. So if you get in the game and you're winning, you're doing a little bit of losses, okay, over a period of time. All right. It happens to me. I get in, I may take a couple losses in a row. Big deal, because you're keeping your risk so low that over the bigger picture, it doesn't matter. All right, it really doesn't matter. It's that when you lever up on your initial positions, that you can put yourself at it again rather quickly. So always prepare that you're going to have a situation where you run into a streak of losses. It just is what it is. But you want to put yourself in a position where you're going to run into a streak of wins, and that's where you start compounding your money. All right. I hope this helps. I took about 30 minutes just to discuss margin, leverage, risk, multiple positions. And if you want, just watch the video over and over again, and I hope it makes sense to you. My name is Christopher Terry, CEO of iMarkets Live. And if you have any more questions, just reach out to the person that introduced this video to you, and see if you can get your questions answered, or email us at trade support at iMarkets Live. Thank you.